Welcome to Yahoo Finance's flagship show, The Morning Brief. I'm Brad Smith alongside Madison Mills. Let's get to the three things that you need to know today.
First up, U.S. stock futures pushing higher following the May jobs report. The numbers for May coming in better than expected, but show slowing jobs growth with downward revisions to the prior 2 months' data. While the unemployment rate was unchanged, employers are cautious about growth prospects as they weigh the Trump administration's economic policies.
Plus, Tesla shares seeing a slight recovery this morning after wiping out $153 billion in market value amid the escalating feud between Elon Musk and President Donald Trump. Elon Musk signaling he's open to making amends with the president after a swift fallout where Tesla CEO posted on social media that Trump would have lost the election without him, among other things. Thursday's wipeout was Tesla's biggest one-day drop on record. As investors assess the implications of the feud, Elon Musk personally lost $34 billion from his net worth.
And Broadcom shares sliding this morning after the company's earnings forecast left investors wanting more. While the company did beat Wall Street's estimates across the board, its revenue forecast for the current quarter suggests that AI spending frenzy isn't as strong as some investors had previously anticipated. U.S. stock futures pushing higher this morning following the May jobs report. Strategists are increasingly bullish on Wall Street, with several lifting their S&P 500 forecasts over the course of this week. So what can we expect for stocks in the second half of this year? Joining us now with more, we've got Kate Moore, Citi Wealth's Chief Investment Officer. Kate, it's wonderful to have you in studio.
Yeah,
thank you for
great
joining
to be here.
us. And congratulations on the new role as well. Talk to me about how you are thinking about stocks in the second half of this year, and can the rally that we're seeing kicking off this morning continue?
Yeah, look, so I grew up with stocks in my DNA, right? You know, this is how I really love to take risk. Unfortunately, I'm not as optimistic as some of the market pricing kind of would now suggest. So let me put it this way. I think there are a number of significant headwinds in the second half of this year that are not being reflected in risk asset prices. And people are afraid to miss a rally if there is one. So they're not positioned, frankly, for some of the weaker news and perhaps some of these headwinds on earnings, on macro, on tariffs, on policy, even if they discuss them. I prefer to stay up in quality in the equity market, so that means a bias towards large caps, mega caps that can earn through all parts of the cycle. And I prefer to stay really anchored outside of the US to countries and markets where I think there could be fiscal stimulus and policy support.
Where are those countries?
You know, we see some areas of Europe. I mean, everyone's gotten themselves very excited about Germany, for example. Also, we have to recognize that spend mostly comes in the second half of 2026. But there's perhaps scope for additional fiscal stimulus on the margin in some European countries. I also think there's more scope, frankly, for stimulus in China. We've had some kind of deflationary pressures. Some of the demand hasn't looked great. That said, we know the government wants to continue to support the market, and they have the scope on both the monetary and the fiscal side if the tariff headwinds end up becoming a real issue in the next couple quarters.
How do you think about which wins out? Fiscal stimulus that drives those global economies you talked about versus U.S. large cap tech that has continued to dominate for the past few decades?
Yeah, look, you know, we have a concentration, of course, in U.S. large cap, which I think makes a lot of sense from the quality bias I was mentioning. But on the margin, one of the trades we did in our portfolios this week was to add a little bit more to the European equities and to China on this kind of stimulus support, as well as perhaps a flows support, which I didn't mention just a moment ago. You know, this idea around whether or not the U.S. should be exceptional in everyone's portfolios, or if it should be the most, that very large overweight that many people had allowed it to become, both from drift and additional ads over the last couple of years, I think is very front and center of mind for allocators. Incrementally, they may put more money outside of the U.S.
What's the risk of kind of nationalist consumerism also trickling into investor mindsets as well?
Yeah, I mean, that's a really good question. It's something we're debating, but I don't know if we've seen any data suggesting any significant move as of now. But there are a couple things outside of just say, you know, kind of the consumer activity. You know, big asset allocators, big institutional investors are having this discussion. How big should one country be in my portfolio if it's not my home country? But they don't make these moves at the start of the discussion. As you know, these are slow-moving reallocations. They happen over a series of quarters, sometimes at an annual or a semi-annual rebalance. And I expect we're going to see this happen in shifts, basically, over the course of the next year or two.
It just seems like one of the initial places that starts to show up is actually in the bond markets if you do have weak auctions than anticipated here.
Yeah, for sure. And the auctions, especially in the long end, are really something we're going to be laser focused on. Look, so far the auctions have gone well, but the fiscal picture in the US is deteriorating. And there may be better international bond markets to allocate additional capital to. And we're kind of looking at that as well. I mean, I think we have a pretty consensus view on bonds. We've been short duration. We've held a little bit of cash. I added a little bit of gold to the portfolios this week. All of that stuff is supportive. But we are not sure at what level we would add to long duration fixed income. And frankly, it's not just us, it's every global investor who's doing that same questioning.
And what is the biggest thing that would have to change to get you to reconsider the longer end of the curve?
Well, I guess it's not just the level, right? It's not like saying, oh, at 5% on the 10-year, we'd want to add. It's more like, how did we get there? And what is the speed at which we got there? You know, if we got there because we all of a sudden have a great view on growth for the next couple years or the medium part of the cycle, awesome. If we get there because the fiscal situation in the US continues to deteriorate and we don't really have faith in the US government in the way that we might have had decades ago, that's not great. So it's not just the level, it's how we got there and how fast.
How long can one basket of companies in the Mag 7 continue to be the shining light or the North Star for the markets to just take their cues and for investors to take the cue from?
Yeah, look, I get it. Everyone is uncomfortable with the leadership and the concentration. But what I will say is these are companies that continue to put up earnings, that have very, very strong free cash flow profiles, have strong management teams, are working in the most interesting and fastest growing parts of the market and the economy. So it's not like they are leading for no reason. And by the way, I would suggest there are lots of parts of the tech complex that are not in the Mag 7, parts of like high quality consumer, things in the infrastructure space that are leading as well, that have those same profiles. Great management teams, high free cash flow, and frankly, are in kind of more secular spending themes.
Can you, and we've got about 30 seconds left, but can you talk a little bit about the declines in the dollar and if you're worried about that impacting US stocks?
I think it can on the margin have some impact. Everyone started this year agreeing that the dollar was relatively overvalued. But I think we're going to see fits and starts, a little bit of a decline and some stabilization. The dollar's not going to lose its reserve currency status, in my view, in the very near term. That said, as we're talking about portfolio reallocations, I think how much people want to own in dollars is going to become to question. And a lot of our clients are hedging their US dollar exposure, especially our big global clients.
I could ask you about that for another hour, but we have to let you go. Kate, thank you so much for joining us.
Thanks
really
so much for having me.
Insights. Thank you. Let's take a look at shares of Tesla rebounding pre-market after shedding over $150 billion from its market cap in the biggest one-day drop ever for the company. Shares began sliding as President Trump and Tesla CEO Elon Musk traded barbs on social media as their disagreement over the Republican tax bill turned personal. Musk claiming that without him, Trump would have lost the presidential election. President Trump responding by threatening to cancel billions and billions of government contracts for Musk's SpaceX, and Musk even saying the Trump tariffs could cause a recession. Initial reports last night suggesting the two leaders could have a call today, but Reuters reporting this morning there are no plans for Trump and Musk to speak. Joining us now, we've got Craig Irwin, Roth MKM Senior Research Analyst. We also have Steve Clemens, the Washington Notes founding editor at large. Craig, I want to begin with you. I know that you have been bullish on Tesla regardless of the slew of headwinds we've seen for the stock over the last year. Are you still bullish today?
Absolutely. I think, the Cybercab robotaxi is going to get, the spotlight next Thursday. I think people are going to be impressed. I'm hearing supply chain for Optimus. They're talking about parts for 30 million robots, right? So, these two businesses, they basically create their own milestones for the next couple of years, and investor enthusiasm for that and the future of AI, where Tesla's a clear leader. These guys are set up for an interesting run. The political noise and the other volatility is more short-term in nature, at least as far as I see it.
Okay, so Craig, it sounds like you believe this is just one part of or one latest episode in the broader season of Trump 2.0. Steve, your reaction to all that played out yesterday and the overhang that it creates for Tesla?
Well, look, I mean, I think that Craig is right, that the fundamental underlying dimensions of Tesla are so strong for the future. But you've got a major spat going on, and the spat's going to have consequences, and there'll be recovery after that spat. But this is a serious political challenge, I think, both for Tesla, and I think it's also, for Donald Trump. Trump and Musk will both survive this, but we've never seen a kind of bromance, between two people blow up this spectacularly, and it will have political consequence unless they're able to kind of patch it up. Musk is threatening to create a third party. He's threatening to create penalties for anybody who supports the big, beautiful bill. And he's really going after Donald Trump in a way we've never seen anybody go after Trump. Trump's threatening to undermine many of the grants and subsidies for SpaceX and Tesla. And so it's a nasty thing that we're just going to have to see play out. But Tesla will survive just fine.
Craig, bringing you back into the conversation, I'm just curious as an investor how you deal with this kind of catalyst for stock that you hold, given the fact that the relationship between Trump and Musk is part of what drove it up over 40% off of the election results. And then it's also obviously part of what drove it down 40%. We're at around where we were before the president won the election. How do you think about the risk of that?
So the closeness between these two men, I think is something that needed to change a little bit, right? These guys have so much in common, right? Tremendous egos, tremendous power, and very strong opinions, both of them. And they're not always going to share the same opinions, but they have an incredible amount in common, right? I look at them and I laugh, and I think both of them stole their dance moves off Steve Martin on Saturday Night Live, right? I mean, they are so similar in so many different ways that it's natural that they would get along really well. Their interests are still incredibly well aligned. When Musk was saying impeach Trump, he's saying, elevate Vance yesterday. So he's not, separating or putting a lot of daylight between his commitments to conservative causes right here. He's saying that I'm pissed off with Trump. I'm very angry. I differ on some of these things, but he's a man with a lot of passion, a lot of emotion, as is our president. And we have to respect that. And the reality is, I think cooler heads prevail. I think at the end of the day, both of them will see that they're actually really well aligned and that they do have differences of opinion. Trump's saying, hey, I got to govern 1.6 trillion. Not so bad. Musk is saying we should have done 2.5. Come on. I mean, I think at the end of the day, the both of them can get together and do a high five and say, you know what, we're winning. Let's make America great again, right? Which is really what they've both been saying. That's just something that's going to be good for Tesla and good for the country.
That kind of turns an eye to the vindictive activity that President Trump has been known to have in the past, expecting that they would just come together and high five at the end of this. So as you're kind of looking through the other broader risks here, not just the Tesla, but of course, and not within a coverage universe right now, SpaceX and the other businesses, it seems like there are different areas where Trump could go after Musk. And Tesla might not be the core focus of that, but it still is the one that investors have to grapple with, at least in the near term, whether they want to hold Tesla voluntarily or do as a result of it being in one of the indexes.
So both of them have a record of being highly vindictive, right? There's some stories that haven't really found their way into these books that have been written about Elon Musk, but he has really humiliated some of the executives that he's fired over the last many years. President Trump, I guess most of the public first knows him from his time on The Apprentice, right? Where he was humiliating people by the way he was firing them, but then it was turned more or less into a comedy, right? And I think that Trump has shown the ability to rechannel that vindictiveness, maybe a little bit more effectively than Musk in the last couple years. And they do both tend to step back from, mistakes or heated situations and reevaluate. So I'm not overly concerned about the short term. I mean, the tremendous downdraft in Tesla yesterday did not give me a good feeling. But I think at the end of the day, we have two men that have the shared interest and shared vision of the future that differ slightly. And they'll both understand that. And I think there will be a coming together. And I do see a high five. Probably not today, but in the not too distant future.
Steve, we got to go. 15 seconds. Are you expecting a high five? We still talking about this story next week, or is the popcorn
I think it's really.
bubbling?
I don't think this is a kumbaya situation between these two men. I think this is going to be a permanent rift. I think they've gone nuclear with each other and gone after each other in such a way and so publicly. I don't see that as a realistic option. I do see both sides surviving well, but when you accuse somebody and saying, hey, they're in the Epstein files, which is really a lot about sexual innuendo, and you're talking about removing all grants and trying to sort of destroy the other person. Musk is sort of the Da Vinci of our times, and he's complicated. But when you have that, this is not going to end in a way that's nice for either one of them. Both equities of the U.S. government and Donald Trump will be fine, and Tesla will be fine. I agree with Craig in that, but they're not going to high five.
Craig, Steve, thanks for taking the time here this morning. We're going to be watching closely to see Tesla shares over the course of today's activity, as well as how this plays out. Thank you.
Thank you.
All your markets action straight ahead. Stay tuned. You're watching Morning Brief. Now time for some of today's trending tickers. We're watching DJT, DocuSign, and Circle. First up, DJT shares taking a hit after President Trump and Elon Musk publicly clashed on social media, escalating their recent feud. The stock, it had fallen, but now you're seeing extended hours right now up by about 2%. On Thursday, it did fall more than 8%, though, wiped out more than $200 million from President Trump's net worth here. And even as we're watching the rebounds for both of these companies, both Tesla and DJT here, pre-market, of course, this comes amid the spat that played out popcorn style in front of all of our eyes yesterday, as investors might have been forced to pick a side as well through their own, through whatever inclination and side they fall on, knowing that these two used to be in a very public bromance together.
Certainly, and that is exactly what Representative Alexandria Ocasio-Cortez referred to when she said that the girls were fighting in reference to the feud. Having said that, tough for DJT, given that there was a positive catalyst for the stock earlier this week after the company appeared to get a step closer to launching its own Bitcoin ETF in a Securities and Exchange Commission filing there. You can see the stock was up for a touch of this week, but now obviously moving to the downside, down a little over 3% over the last 5 days. Next up, DocuSign is lowering its full-year billings guidance. Still, the electronic signature software company topping revenue expectations for the first quarter. DocuSign also announcing a $1 billion increase to its share repurchase program. You can see the stock down over 18%. It mirrors a trend that we have seen throughout companies that signal any sign of weakness in their forward guidance. That is certainly going to be a killer for them, and we've seen that playing out throughout this entire earnings cycle and beyond, again with DocuSign lowering that full year billings guidance.
Yeah, that guidance, DocuSign projecting revenue between $3.151 billion and $3.163 billion. It's actually a 6% growth rate. That is for the full fiscal year. They also anticipate billings growth to accelerate. That's going to be in the latter half of the year, which essentially is just a few weeks away at this point. And then additionally, the executives talking a little bit more. We've had Alan Tagieson on Yahoo Finance a few times, been kind enough to take some time with us, but reiterating the leadership reimagining agreement management through its platforms and then emphasizing their strategic executions here. However, the slower growth in the real estate sector, that's seen as one of the areas that could potentially be a headwind to revenue. And then additionally, just billing cycles. We talk about deal scrutiny. We mentioned it in one of our earlier discussions today. That is something that DocuSign also has to weave itself through as well, and could have a larger overhang potentially on some of the performance obligations. So all that considered, taking a look at DocuSign shares, they are down bad by about 19% right now pre-market. Finally here, we're tracking Circle, extending gains after its strong New York Stock Exchange debut. The stablecoin issuer soaring 168% Thursday, raising more than $1 billion in its IPO. Trading was halted more than once due to volatility here. You're seeing shares pre-market add on another 18.3% right now.
Yeah, it's interesting to see the degree of success around Circle, especially given that their USDC is the second largest stable coin in the world that comes after Tether's, which is USDT. Interesting also taking a look at some research this morning from ARK Invest, estimating that the total value transacted through stable coins was higher than Visa's transactions in the year 2024. So certainly that is a signal of a potential catalyst for this name, which is still up pre-market here.
Yeah, just some background on this too, additional context that might be valuable for our viewers here, just in the significance of this. Largest ever pop for $1 billion IPO. This is according to Renaissance Capital here, and this is the number 2 stablecoin issuer in the world. Originally only planned to raise $600 million, offering 24 million shares at a range of $24 to $26, but see exactly what it's trading at here this morning, even pre-market. It seems like there's a lot more room to run potentially.
Absolutely.
Also, we're tracking Broadcom. This has been a big story of the week. Broadcom beating second quarter earnings estimates, but its outlook failing to impress investors. Still, the chip maker's AI revenue increased 46% from a year prior. Joining us now, we've got Kimberly Forrest, Boca Capital Partners founder and chief investment officer. You said the AI trade is back. I mean, did it leave? How are you looking at Broadcom right now?
Well, I think that they are a very confusing company if you are an AI-oriented investor, because the chip sector in that company, or that chip segment, I should say, is relatively small but important. We know that, but it's got a lot of weird hardware rolling around the halls in Broadcom, like everything from mainframe to VMware, which is this software that can make virtual machines. So it's an oddball stock, and it's kind of reflected in the price today because it isn't the AI pure play that people want it to be.
So given that, Kimberly, can you talk a little bit about what would make a company like Broadcom a pure enough AI play for an investor like you to be a little bit more bullish on it?
Sure. Well, they could do something strange, like kind of roll out a piece of it, maybe the chip sector, into a trading vehicle where you're just spinning that off, but you remain the majority owner of the company. And that could show in a direct way the growth that the company can achieve through AI. God knows they talk a lot about it, but until investors are able to see that pure growth, that is going to limit this company at some point.
You know, is there a better kind of longer term play here that seems more stable than Broadcom within this AI trade right now?
I don't know. I mean, AI, the good thing about Broadcom's software exposure is that it does give it stability. Yes, the mainframe market isn't growing, VMware's market isn't growing, and the other software they have, not really growing at the same rate of AI, but it gives you a lovely annuity-like revenue to be able to invest in things like the chips that it is bringing to market to AI. So that, if you're a nervous AI investor, maybe Broadcom's for you. The pure play is, at this point, NVIDIA. They have the chips people want that are willing to pay up for their premium pricing. And it looks like there really is no substitute at this point. So if you want a direct line to all manner of AI, the way to play it is NVIDIA right now.
And when you think about the growth prospects for NVIDIA amid some of the geopolitical tensions, obviously NVIDIA getting caught in the crosshairs on chip export curbs between the US and China, how concerned are you about the Chinese market getting cut off from NVIDIA as a potential downward catalyst?
I'm not particularly concerned, but the company sure is. The last time Jensen Huang was on TV, he was making a direct appeal to the government to allow for export. He always points out 50% of the AI is being developed in China, and wouldn't it be nice to have a US-based hardware platform that it's being developed on? And right now the answer is no, for many reasons. And I think probably the biggest reason is, are they going to just have consumer-oriented AI, or does it have military applications? And that's a tough one to get around. So I think NVIDIA making a a less capable chip for the Chinese environment is probably the best the company and the government can do at this point, and we'll see if that's permitted in the future.
Kim, thank you so much. Appreciate it.
Thank you.
We're going to have all your markets action ahead. Stick around.
That is the opening bell on Wall Street and in Midtown Manhattan at the NASDAQ, where you've got Omar ringing the opening bell. And at the New York Stock Exchange, you've got a good look at the floor of the New York Stock Exchange. And let's go back up to the podium, where you've got the Generation Essentials ringing the opening bell. All right, yeah, big handshake there. All right, we've begun today's opening, and yeah, that's the opening cross. Taking a look at the Dow Jones Industrial Average, we opened the day higher by about 0.9%. This on Jobs Day, where we did see the non-farm payroll headline print come in a little bit better than expected, and then the unemployment rate that essentially was in line with expectations there. So fractional gains for the Dow and the S&P 500 to the tune of 0.9%. NASDAQ Composite clicking in there. That right now is up by about 1.2%. Let's go a little deeper into today's opening cross. Taking a look at some of the sector activity here. We've got it pulled up on the screen. All 11 S&P 500 sectors are in positive territory out the gate here on this Friday. Taking a look at XLY, that is leading the pack right now, out in front by about 1.3% here. You've also got some positive moves in, well, everything, but also technology and communication services, worth note. And then taking a look at the NASDAQ 100, only a few spots of red peppered into the mix there. And yeah, you guessed it, Lululemon, one of the biggest decliners there. We're going to break that down a little bit more in just a second here, so stick around for that. That's post-earnings. They're down 18% on the day. And then AVGO, Broadcom, those shares moving lower by about 3.5%. They did see some new all-time highs this week. However, the guidance failed to impress investors, and that's what's sending the shares lower as of right now. We'll continue to track that, but really only a handful or two hands of names here moving lower for the NASDAQ 100. However, Tesla trying to rebound. Let's take a look at that amid what is likely taking over your social media feeds in the spat between President Donald Trump and his former bestie, Elon Musk. We will see how that plays out, but ultimately shares, they are rebounding. Let's put this on a two-day view here. Yesterday, there was a much larger decline, and so as you can see, over the past two trailing sessions, we're still down by about 9%, but here today, out the gates, up by about 6% right now. We're also seeing some gains out the gate in Micron technology. All right, here, we got it loaded up. There we go. Full screen pops up. All right, over the past 2 days, up 5.7% here, up by about 3%. And then just lastly, I'll look at the Dow components here, and we'll ride out there. Taking a look at the 30 Dow components, only two laggards. Wow, okay, McDonald's, the golden arches got a little bit of rust on them right now. And just like that, decides to flip positive. So who am I? Nike, though, that's flat, just barely to the downside here. We'll see if that can get into positive territory. Maybe we can get all 30 of the Dow Jones components in positive territory. But we got a lot of trading session left here, Maddie.
We certainly do, Brad. And because of that, it is time now for today's strategy session. Treasuries selling off a bit today as the latest jobs report bolsters the case for the Fed to hold rates steady. With the labor market showing signs of gradual moderation, when can we expect to see those cuts from the Fed? Joining us now, Brian Jacobsen, Annex Wealth Management's chief economist. We also have strategist Omar Aguilar. He is Schwab Asset Management CEO and CIO. Thank you both for being here with us this morning. Brian, I want to start with you. Talk to me about your read on the labor data and just how you factor that into your kind of forecast for the economy at the moment and where we're at.
Sure. Yeah. Thank you for having me. So here at Annex on our investment committee, when we were looking at the data, we really do think that it really supports the idea that the economy is resilient enough to basically skirt a recession this year. We did see some slowing in the payrolls growth earlier this week. There was a little bit more anxiety because of the content of the beige book, the ISM manufacturing and service indices, the ADP numbers. All of those are pointing to some sort of almost like kind of fissuring of the labor market, but it's not bad enough where it looks like we're going to tip into a recession. So from the big macro perspective, we think that it supports the idea that we're going to experience some slowing, but not stopping of the overall economy. And that should be a bullish indicator for earnings on a going forward basis.
Omar, I want to get your take and your read in, your recession probability and what that translates through to for portfolio strategy.
Yeah, well, the recession risk, have come down significantly since April. I think, we went at the high levels of risk probability of recession back then, mostly because of reflection of the uncertainty and the numbers that we saw in terms of potential inflation implications. I think it's interesting to see just the labor market numbers today because it does show a little bit of slowing down of the growth in the labor market. That being said, we also see a significant reduction in the size of the labor market. Just a lot of that reflecting immigration policies, that came down by around 600,000. So the overall the participation rate has come down. So what that translates into is, it probably is neutral for the Fed in terms of decision making. And what that means is, probably we're still thinking about early September as the earliest for them to do the first cut, because this labor market report, even though it does show signs of softening, it doesn't necessarily translate in potentially reduction in inflation numbers.
Brian, bringing you back in here, how does the broader sign of softening impact your investment outlook or your strategy, if at all?
Yeah, so the way that we're looking at it is you really have to think about what is the end game for tariffs, tax policy, deregulation. And back in April, a lot of people were increasing their odds of a recession for this year. Really, the market was pricing in a near certainty of a recession. But we didn't take that view because we thought the market was losing sight of what the actual end goal is likely to be. And that is probably having some baseline level of tariffs, continued tension between the U.S. and China, but not necessarily to the degree that we were seeing with those Rose Garden, with the poster board that was on there. So as a result, we were staying fairly bullish as far as looking at companies that have strong balance sheets, demonstrated profitability, but most importantly, an ability to expand those profit margins. If we're going into a period of slight economic slowing, but not a recession, I don't think it pays to be too defensive, but you don't necessarily want to get over your skis with your cyclical exposure. So we're liking financials, industrials, and technology. So kind of a nice mix of sectors that hopefully could benefit from a little bit of deregulation, maybe the market overpricing the likelihood of a recession, and then also some more attractive valuations with some of those cash cows in the tech area.
Omar, we keep hearing that there's the potential that we're going to be range bound over the course of this summer here with really just a spate of news that still could come out. So even with some of that range bound expectation, yet knowing there still could be fireworks mid-July, early July actually, coming in the form of whatever tariff negotiations net out. Also, you still have a Fed that's going to be meeting, and in June, in 2 weeks, I guess, they're going to be having their first meeting of the summer, July, and then end of the summer in September here. What, if any, in the data is going to kind of sway the markets to try to best anticipate the Fed on top of what they're reacting to in the tariff policy?
Yeah, well, it is true. I think if there is anything that we know for sure is that uncertainty will continue. And as you pointed out, markets seem to be already in a range-bound territory. We have seen both equities and bond markets just moving around the same levels, since probably the end of May and going into these first few days in June. And a lot of that is reflected even in equity market volumes, where things haven't not been as deeply traded as normally is, before going into the summer vacation. So investors are obviously looking at, what the implications might be of these negotiations of, after the 90-day pause and what would be the subsequent piece. The estimate is, especially just at the high level with all the research numbers, that we're going to go from a 2% tariffs that we have back in 2024 to at least 7% tariffs. And that obviously, the impact of that in terms of inflation, in terms of prices, in terms of earnings, is still unknown. And I think that goes back to the question about, what kind of data and outlooks we're going to see from companies going down the road as their potential impact on there. I think the key questions that in terms of data is consumption. At the end, our GDP growth, continues to be highly dependent on consumers. Mm-hmm. And I think the question will be how much of that consumption continues the way that we have seen it this year, mm-hmm. and how much of that is just, that people anticipated and started doing the consumption early on in anticipation of the potential impact into the economy for tariffs.
Brian, Omar, thanks so much for taking the time just after the market open.
Thank you.
Let's get to the three market movers you need to watch for the trading day ahead. Yahoo Finance's Jared Blickery has more.
Well, thank you, Brad. Taking into consideration the entire week, we see some mixed signals from risk markets. Also, we got some Mag 7 drama, read Tesla right there, and also commodities heating up. We've been tracking silver and some others all week long. So let's dial up the Wi-Fi Interactive and take a look at the 5-day price action in the NASDAQ. You can see up 2.26%. That is leading the majors. Dow not quite there, but still up 1.34%. You can see in the last 24 hours, it's added some nice gains to that, almost breaking even yesterday morning. And then the S&P 500 kind of in the middle, around 1.5%. But I also, and let's take a look at the VIX, because I was just taking a look at that and noticing that it is at the weekly lows, 17.14. So that is another good sign for risk markets. But what is balancing that to the downside? The 30-year kind of creeping up here. It's up another 5 basis points. Again, this is a 5-day look, and it was at 5% to start with the week, came down nicely, but now it's on the way up. So 4.93%, and we'll be watching to see how it reacts, how stocks react if it does climb any further. And let's take a look finally at Bitcoin. Bitcoin had a pretty wild ride over the last 24, 36 hours, came all the way down, touched 100,000 nearly, and it has bounced up quite nicely since then. Let's take a look at the year-to-date. I was talking about the potential for a false break to the upside, something that Bitcoin has been famous for, but I really like the price action off of that $100,000 low, and that seems to be something that's supported. So that's my make or break line in the sand right there. Got to check out the NASDAQ 100 for, guess what, the Mag 7, and the drama is all Tesla. Tesla was losing $140 billion yesterday. Let's dial that up. It is up 5.39% today. Here is the 5-day look. You can see it's still down about 13.4%. And guess what? Microsoft in the top spot again, just hit a record high, the first one in almost a year. You have to go back to July of last year. Microsoft hitting a record high, and it is the biggest stock, once again, trumping NVIDIA. And then finally, a look at the futures market. I'll put the 5-day view. One of the leaders here has been silver, and you can see up to 36.34. That is a pretty strong showing. It just broke to the upside to multi-year highs, over a decade high in the last 2 days. So that's on my radar. And then let's take a look finally at crude oil, just around $65 per barrel. If I put the year-to-date chart on, you can see volatility has kind of contracted here, but what I'm watching for is a potential break to the upside, $65, put 70, 75 in the cards. And I'll send it back to you, Brad.
Jared, thanks so much. Appreciate it. We've got all your markets actions straight ahead. Stay tuned. You're watching the Morning Brief.
Shares of Lululemon down double digits after the athleisure brand cut its full-year earnings outlook, citing economic uncertainty and tariff-related costs. Here to break down the company's latest quarter, senior reporter Brooke DePalma. Hey, Brooke.
Certainly what we saw in this first quarter results is those mixed results were overshadowed by that Lululemon's decision to cut their second quarter and full-year earnings outlook. Now, the company does expect second quarter adjusted earnings per share to fall in the range of $2.85 to $2.90, and that's far lower than what Wall Street was looking for here. They expected second quarter earnings per share to come in the range of, come at $3.31. And as you could see here, that then led to them cutting their full year earnings per share outlook to a range of $14.58 to $14.78, down from $14.95 to $15.50. Now, the CEO on the call, Kevin McDonald, called it a dynamic macro environment. And he said that these tariffs have brought uncertainty into the retail environment as consumers really try to assess the impact that these tariffs will have on their daily life. Now, the company's guidance does assume a 30% tariff on China and a 10% tariff on all countries. He also went into weigh on the U.S. consumer. He said, my sense is that the U.S. consumer remains cautious right now, and they're being very intentional. We saw U.S. same-store sales fall 2% in the first quarter, but this guidance that the company has put out assumes that tariffs stay as they are right now. Of course, we know that negotiations are currently underway. They still will be until July 8th when final offers or negotiation, this 90-day pause is up. It assumes a 30% tariff on China, 10% tariff on all countries. And they also said they're using mitigation tactics like we've heard from so many other companies. Think pricing, think sourcing. But they did say that the second quarter guidance also reflects a higher promotional environment here in the U.S., citing that given consumer confidence and macro concerns concerns as they move into the second half of the year. And so the real question here, are U.S. consumers especially willing to pay up for Lululemon products? That is the big question here.
I mean, Canadian brand that is well positioning itself in China, clearly. Yeah. China mainland increased 8%, if that was one of the bright spots of this report here.
Yeah, just one of the investors certainly looking though at that outlook, for sure.
Yeah, absolutely here. Look, I've got more in the we made too much that I still want to be able to purchase. So.
Right. I love the we made too much, I have to say. I mean, not good for Lululemon. Inventory was up tremendously over the quarter, I think roughly more than 20%. But hey, good for us consumers. Love to shop the sales.
They were doing a promo at my yoga studio where the first people who signed up at the studio got a free pair of leggings. And I was like, maybe that's a form of like new marketing they're trying that's less influencer focused. I've heard them talk about that before, more focused on regular people using the product in a class, getting people to buy more of that product.
Right, trying to certainly extend their customer base, but also what they've struggled with in the past is like finding that exact right price point and also finding the exact right color, as we've heard in previous quarters, that consumers want to splurge for.
Well, good news for us, bad news for them, as the full year gross margin expected to decrease 110 basis points due to tariffs and slightly higher markdowns. Brooke, thanks so much.
Thank you.
We've got all your markets action straight ahead. Stay tuned. You're watching Morning Brief.
Welcome back to Yahoo Finance Live. I'm Jennifer Schongberger. A much stronger than expected jobs report for the month of May. 139,000 on that top line non-farm payroll number, though a bit of a slowdown from April. The unemployment rate holding steady at 4.2% and average hourly earnings clocking in at nearly 4%, jumping up from what we saw in April. For more insight on this morning's report, I want to welcome into the program Labor Secretary Lori Chavez de Reamer. Madam Secretary, it's great to see you on this warm morning in Washington.
Well, I'm excited to be here. It was another great day for the jobs report.
Well, let's talk about it. Your reaction to the jobs report and the state of the health of the job market now.
Well, 139,000, beating expectations for the third month in a row. I think President Trump should pat himself on the back for that leadership and giving us the latitude to go out and work very hard for this jobs report. What we're seeing is hourly, you mentioned, hourly wages are up as well. This is key for the American people. This is something that has been holding steady. Unemployment is holding steady. So we're solid on solid footing, and we should expect them to keep growing month after month.
And this jobs report coming when tariffs were full blast. Just this past week, we learned that job openings actually increased more than expected. Do you think that this pace of job creation can continue per month as we go through the year?
Well, if President Trump continues to double down on these types of negotiations and understanding he's leveling the playing field with these tariff talks, and companies continue to invest tens of trillions of dollars, we're going to see the labor participation rise. We're going to see job growth increase. We're going to see unemployment decrease. And, for instance, I was just with the president last week in Pittsburgh to talk to the steel workers. The investment there, $14 billion and another $14 billion. They couldn't have been more excited for their local communities to know that the president is fighting on behalf of them. Those are labor jobs. Those are blue collar jobs. Those change people's lives.
You mentioned the labor force participation rate. We did see that drop a bit. Based on what you just said, do you expect a rebound in that? And what do you owe to the drop that we saw
Certainly, we were briefed this morning by BLS, labor statistics. I mean, really, it's statistical noise. It's just, 0.2%. So we're seeing that. That doesn't surprise, I don't think, anybody who pays attention to these numbers. What we did see is the increase in the job numbers, the actual increase. As I tour around America at work, I think we talked about it last time. I've been to 13 states. I am seeing the private sector investing in their local communities as well and working with our community colleges, with our career and technical education systems. They're building centers of excellence in order to have the skilled workforce that they need for their sectors. We saw construction jobs go up. We've seen healthcare jobs go up. We're seeing manufacturing jobs hold steady, but still better than under the Biden administration. So this is an exciting time for the president. It's an exciting time to see 500,000 new jobs since the president took office. And again, I would expect these numbers to continue to climb.
As the labor participation rate dropped, we saw earnings increase. We've also seen immigration drop. I'm curious, with all of these factors in play, could we see a tighter labor market with higher wages as we go through the year?
Well, I would imagine with almost 4%, we've seen the hourly wage increase. That matters to the everyday worker, that they can keep more money in their hard-earned money in their own pockets. And if the labor market does tighten, we're going to create more jobs. That's the focus of this president with our executive orders. 1 million new apprentices. We're going to be focused on spending a lot of those grant dollars for AI to folks that we're training. The new native-born Americans are taking most of these jobs. That's what we've seen since the president. Native-born Americans have these jobs, these job increases, and then we have young people who are native to AI. And so when we skill them, you can imagine the trajectory that we're going to have in building the workforce.
Members of the Federal Reserve are expecting that inflation will increase and unemployment will go up as a result of the tariffs, whether that's short-term or long-term. But if we look at the solid jobs report this past month, at the same time, we also saw inflation drop in the month of April. Is the Fed wrong?
Well, I think the president is doing a good job about really the holistic approach and the three-legged stool. As the president, and on top of that, I want to talk about this big, beautiful bill. Because as the president works with Congress in order to secure permanent tax cuts, that also will continue to support the economy. What I know is that the one big beautiful bill that the president is pushing, it is good for the American people, and that is going to create the one big beautiful workforce. And that's the doubling down of the leadership from this president and allowing us to have the latitude to go out and work with the private sector jobs in order to create that. So while he'll work with the feds and while he'll work with the Treasury, they'll determine on what's best for the American people and where the pressure comes from there.
Do you think if we do see 100% expensing and depreciation for factories and depreciation, I should say, made permanent in this tax bill, what kind of job creation could we see as a result of that, particularly in the manufacturing arena?
Well, when a company can release some of their capital funding to invest right in those manufacturings and have a write-off, which this bill allows for, I think that's just another doubling down, and that the president has the focus of the American people and the American business at heart. He wants people to flourish. Businesses are wanting to flourish in this country, and that's why you're seeing companies onshore. That's why you're seeing companies come back and invest billions, if not trillions of dollars, and that adds up, and then they're going to need that workforce. And so that's my part of the equation, where I can come in behind the president, behind commerce, behind Treasury, and say, we're going to create that workforce, we're going to skill these American workers, and they're going to be ready to go on day one.
Madam Secretary, thank you so much for your insights. So appreciate it.
Thank you.
Guys, I'll send it back to you in New York.
All right, Jennifer, thank you so much, and thank you for bringing us that conversation as well. We're going to look at the major averages this morning, continuing to move to the upside off the back of that jobs data. We've got your S&P up over 1%. We haven't seen that strong of a rally throughout the course of the last 5 sessions. You also got your tech-heavy NASDAQ up 1.2%. A big question, will we continue to see this rally as we head into the close for your trading week here? Of course, we'll bring you all those moves throughout today's trading day. But for now, that's going to do it for the morning brief. You can join me in the next hour for more analysis on Catalyst and Brad for Wealth after that. Stick around.